Welcome everybody. My name is Greg Meyer. I'm a certified financial planner with Pash-Benson. I'm very excited today to speak to Gary Benson, president of Pash-Benson, about the advantages of executing a 1031 exchange. And Gary's going to share with us and his experiences in assisting clients with 1031 exchanges, as well as educating us about how 1031 exchanges work. Benson, we've been in business for over 30 years. Here we do comprehensive financial planning, which means we help clients in all areas of personal finance, which include income tax planning, retirement income planning, liquid savings strategies, investment planning, risk management, and estate planning. And today we're going to focus on income tax planning as a 1031 exchange is a valuable tool to defer capital gains taxes by exchanging investment property for another investment property. And Gary's going to share with us some strategies and his personal experiences and educate us about the 1031 exchanges, specifically to what is called a Delaware statutory trust, which is only available through individuals that have a securities license. So without further ado, I'm going to ask Gary questions, and he's going to share with us his over 20 years of experience.
A 1031 exchange is basically where you have an investor that owns an investment piece of property, and they're interested in selling that property, but they don't want to pay the capital gains tax. So you can do a 1031 exchange if you follow the certain IRS guidelines to sell that property, and once you've sold it, you can purchase another piece of property to replace that. And several clients have been taking advantage of that, but more recently, when a client has actually held the property for several years, they're getting a little bit fed up and tired with the management of the property, and they would like to sell the property, but they don't want to do the management anymore, but they don't want to pay the taxes. So by doing a 1031 exchange, that will accomplish that. But then there are also ways that you can do a 1031 exchange instead of having 100% ownership, which is most of the way investors hold their property. You can invest in properties with a partial interest in the piece of property. For example, you can buy with $100,000 or $200,000 equity or investment a piece of a large commercial property that could be valued at $25 million.
Let's say somebody owns a $1 million property, and they would like to cash out $300,000-$400,000 of it, and they understand they need to pay tax on that portion, but they want to avoid paying capital gains tax on the balance. Can they still execute a 1031 exchange?
Yes, investors can do that. They can actually sell the property. They can actually take out whatever amount of money they want. They will pay tax on it. That's called on the IRS terms boot. So they would actually take out, in your example, say $300,000. They would pay the capital gains on that $300,000, but they would be able to take the remaining equity that they've received from the proceeds of selling their investment property and do a 1031 exchange on that. A Delaware statutory trust is basically a structure on how you can an investor can invest using a 1031 exchange. It's more like a person having a living trust. You use a living trust as a structure to help avoid and minimize estate taxes. A Delaware statutory trust is a separate a structure that is approved by the IRS, whereby you can use a Delaware statutory trust to invest in investment property, and it qualifies as a 1031 exchange. The main benefit of a DST structure is you're able to invest a lower amount of capital, say $100,000, $200,000, or $500,000, and within an investment company that has professional management, and they're going to manage the property for you. But the property that you're buying into, which is just a partial ownership of that property, could be worth $25 million or $100 million or $50 million. So you get the economy of scale by being able to invest a smaller amount of money into a larger piece of property that's also professionally managed by experts in the real estate industry. Investors have always been able to do a 1031 exchange on their own with individual ownership, but it's just been over the last 20 years whereby a investor or owner of a rental type real estate property can actually now invest in a piece or a portion or a percentage ownership of a large piece of property. Now how that evolved, which is known as the Delaware Statutory Trust, originally was known as tenants in commons, or TICs, whereby you could still invest in a partial or percentage ownership of a piece of property, but you were on title as a tenant in common ownership with several other investors. That has become very cumbersome, and the industry looked for different structures that would not make that type of structure as cumbersome. And Delaware Statutory Trust came about in 2004 and is completely approved by the IRS, whereby you can now own a percentage of a large piece of property with a minimal amount of investment, say $100,000. Usually the minimum is $100,000 or more. The tenant in common TIC type structure, they both work and have the same result in the end. You're still able to defer the taxes. The main differences are on a TIC, if there are any management changes or things that need to be done with the investment in the future, you need a majority or sometimes 100% vote. So you need all the investors in a tenant in common structure to agree to make any changes on the investment property that is being managed. And sometimes that becomes a problem because there may be something that needs to be done to the property, and if just one or two investors disagree, then you're not able to accomplish that task, and it could be detrimental to the property. On a Delaware Statutory Trust, the managing firm basically can make all the decisions, and hopefully they're the right decisions to manage the property. An example of what we did with an investor, of a client of mine that had a rental piece of property, is the property sold for $2 million. I'm just using round numbers. There was debt on the property of $500,000. So there was $1.5 million of equity that needed to be invested using some form of a 1031 exchange. This particular client liked to manage property themselves, but they didn't want to manage all of it. They would like some additional diversity. So in this example, this investor took and bought a piece of property for cash, $500,000, and we were able to structure the other $1 million diversify into three different assets, which were net lease, apartments, and storage, to give them proper diversification, less management, but it still allowed them to invest $500,000 of their proceeds in a property that they were able to manage themselves. Right now, the real estate market is at pretty much all-time highs, and particularly here in California. So several investors have property that have a significant amount of equity in them, and so it appears that you usually want to try to sell assets when you're at the height of the market, and that may be where we're heading, where we're at right now. And there's several investors that have had these properties for many years, and they've been managing them, and they're getting closer to the retirement age, or they are retired, and they just really don't want to manage those properties now. So there are some very good options now by using these 1031 strategies to be able to diversify their portfolios of real estate by using 1031 exchanges and alleviate all that management. The main guidelines of when you do a 1031 exchange is to defer all your taxes and not pay any capital gains taxes are when you sell a property. Let's say you sold a property for $2 million and it had a mortgage or debt of $500,000. The replacement property, and it doesn't just have to be one, as we mentioned earlier, it could be several properties, but the replacement properties have to be, the purchase price of all combined properties has to be equal or greater to what you sold it for. So in this example, we sold for $2 million, so our combined purchase prices have to be over $2 million. Also, there's a debt requirement, and that is on the replacement properties, the combined debt must be over $500,000. If you do not meet those parameters, meaning you buy a piece of property less than $2 million in this example, or the properties that you purchased have less than $500,000 of debt, then you will pay tax on that difference, and that is considered food.
For clarification, Gary, on the example that you just gave, so what I'm hearing is that on each replacement property you would have to have a certain amount of debt so that all the debt totals what the debt was on the original property. Is that right?
Yeah, that's right, Greg. So the debt, let's say that the debt on the original property was $500,000. You can purchase replacement properties, and let's say you were invested in 4 different replacement properties. One of those replacement properties didn't have any debt, it was all cash. As long as the combination of the remaining 3 properties, if you add up all their debt, came out to $500,000 or more, then that will properly qualify as a 1031 exchange, and there will be no tax. The guidelines to doing a 1031 exchange is first you're going to sell your piece of property. So once you've sold the piece of property, the proceeds you cannot receive yourself. The proceeds have to go into a separate type of an escrow that is known as an accommodator. So accommodator is going to hold those proceeds or equity that you received from selling your property. Now once you've sold the property, you have 45 days in which you must identify what you're going to purchase. Now you can list, there are several different identification methods, and we're not going to go into all of those today, but basically you have 45 days in which you can list properties. You don't have to buy all of them, but you have to have a list that detail the property's addresses and location of the property. You don't have to have the amounts, it's just you have to identify where the properties are going to be, and you have 45 days to do that. In addition to that, to close the property or properties that you're purchasing through using a 1031 exchange, you have 180 days to be able to close escrow on the properties that you are purchasing. Under the IRS guidelines, to effectively do a 1031 exchange without paying taxes, an investor cannot physically receive the proceeds themselves. So they actually have to have some other means or some other form or a way of holding those assets. So an accommodator is, like I mentioned earlier, is like an escrow company. The money goes with the accommodator. The accommodator holds the money, and then you as the investor give direction to the accommodator on what property or properties that you want to purchase. Now you can do a 1031 exchange without using accommodator, but it's very difficult, and I have done this in the past. And that would be, and how you would have to do that and line that up is you would, on the property that you sold, you must close escrow. You must simultaneously close escrow on the property you sold and the property or properties that you're purchasing. So in that example, without using an accommodator, you would have to buy and sell, and both escrows would have to close on the same day, which is very difficult to do. So that's why the the use of an accommodator has come into play to allow investors to take a little bit more time to be able to close escrows on the properties that they want to purchase. The main disadvantage that I see of a DST is that you're going to lose control. You're going to lose some control. So you will, if you needed to sell that your interest in a piece of property or a property that you purchased using a DST, you may have a more difficult time doing that, and also any management decisions on the investment property, you don't have any control over. Sometimes that's a good thing, sometimes that's a bad thing. I mean, sometimes the decisions you would make may not be the appropriate decisions. Remember, these DSTs that we are recommending for our clients, we're using sponsors or companies that actually have been in the business of real estate acquisition and management, so they're experts in that area. So that could be a disadvantage. I think sometimes it could also be an advantage, but the main disadvantage on using a DST structure is lack of control.
Thank you, Gary, for sharing all of your experience in assisting clients in executing 1031 exchanges to DST properties. Personally, I'm surprised. I found that the public is not so familiar about DSTs, and now that you've shared with us your valuable experience, do you have any other comments?
Greg, a couple final comments on the Delaware Statutory Trust. You made an excellent point, and I believe that a majority of investors that are investors in real estate properties now do not know much about the structure and the benefits of a Delaware Statutory Trust or a DST. A couple of things I really like about the DST is if you have in just your regular portfolio stocks and bonds and cash and gold and what have you, a lot of times you like to diversify that. A lot of times when you have a real estate asset, especially one you've had for many years, it's appreciated significantly, so that could be a very large portion of your assets all in one area. Whereby if you actually to resell that and not pay the tax using a 1031 exchange, by using a DST structure, you can diversify that in several different areas that could benefit you and more or less reduce the risk. One last comment where I think a DST structure is an excellent tool can be for those investors that are doing an exchange. And I'll give you an example. Let's say they had a property they sold for $2 million. They wanted to purchase another property and they found one, and it was something that they really liked, but the purchase price was $1.5 million. So there's $500,000. The difference, that they would have to purchase another property for in order to not pay any capital gains tax. Majority of those investors would just end up buying that property for $1.5 million, and they would end up paying capital gains tax on that $500,000. The beauty of a Delaware Statutory Trust is that particular investor now, in that example, could take that $500,000 and place it in 1, 2, or 3 or more Delaware Statutory Trust investments and be able to diversify their property and not pay the capital gains tax. So I think that structure, Delaware Statutory Trust, can be a very excellent tool in doing 1031 exchanges.
Thank you everyone for listening. Thank you, Gary, for sharing with us your experience with clients. We're very excited about the opportunity with 1031 exchanges. Here in Southern California, for example, we've seen tremendous appreciation in real estate. And for those who are approaching retirement or already in retirement, who are tired of managing their real estate, would like to increase their income and avoid the tax, the 1031 exchange to a DST is a valuable tool, if not for the proceeds from an entire sale, but rather a partial exchange. Just a couple of examples of clients recently might have bought a property in Northern California for $100,000, which is 30 years ago, which is appreciated to $500,000, rather than sell and pay the taxes on the gains of $400,000 by executing a 1031, moving it into these DST properties. They managed to eliminate their taxes, double their income, and avoid the capital gains taxes. So we're really excited about the opportunity, and as I mentioned in the beginning, we do comprehensive financial planning. So in addition to helping individuals with this one area of income tax planning, we help in all areas, and we invite you to come into our office or to call with any questions. Our telephone number is 818-990-9777. We look forward to the opportunity of meeting you and hope that we can assist you in the future.